Hello, Steve Lentz here with Discover Options, and welcome to this edition of the Market Reports for Friday, September 16th, getting ready for Monday, September 19th. Today you'll get two reports meant for advanced options trader. This is the S&P 500 Condor Butterfly Timing Report and also the S&P 500 Directional Likelihood Report. We'd love for you to subscribe. You can do so by clicking on the button below. Also, for those of you looking for a few free items at discoveroptions.com, you can get this e-trading book free. It's free, of course, by clicking on the link above, I believe on the top right, Simple Steps to Options Trading Success, co-authored by myself and Jim Graham. We have two reports for you here today. We'll take a look at the first one, the Condor and Butterfly Timing Report. This is an advanced report for those that like to do range trading strategies in options called butterflies and condors. It's a way of collecting options premium in a market neutral fashion, and you typically want the market to trade in a range rather than going crazy and going in either direction radically. And so we have a timing report to help you ascertain whether now is a good time to contemplate these kinds of strategies given the market condition as of Friday. So we're going to go over why you should take a look at this report. We'll go over the methodology, and then we'll take, of course, a look at the current condition and the results. So if you have the market trading in a range, it's not necessarily indicative that you should do butters and condors and assume that the market's going to stay in this range. The technology we've developed here at Discover Options enables us to evaluate this, and in the case of December 31st back in 2015 is that at that point there was an actual negative edge going into this. Even though the market had been trading in a range for a good month or so, there was a negative edge based upon the algorithms that we have here, minus 4.2. What this means is that at that time there was a higher than usual likelihood that the market would be more volatile than what was implied by the option prices. Okay, and we get that a higher than usual likelihood that the market would be more volatile than what was implied by the option prices. That's not good if you're a premium seller using butters and condors. So we're going to do this same report to you an edge based upon the current market condition as of Friday. In this case, with December 31st, the market ended up getting real volatile to the downside. And of course, we can cherry pick examples all we want, but the methodology is the most important thing for you to believe and agree in it, agree with it and believe in it, of course. So we're going to get right to that. Here's the current market condition. Thursday was an upswing day, higher high, higher low. Friday was an inside day. All this occurred underneath the 50-day simple moving average, and with the stochastics, the 15-3 stochastic, going down pretty low into the 20s and coming up. Okay, we're above the 3-day moving average there, and this condition doesn't happen that often, to be quite honest, where you have an upswing day and then an inside bar, all while the stochastic is turning up and we're underneath the 50-day moving average. Actually, if you were to go back to January of 2000, the number of times this has happened is well under 40. Not even 40 instances where this exact same market condition occurred with the parameters I'm showing you here. So we don't really have a huge population of examples to draw from, but we're going to anyway and report on you the statistics behind those. Is this condition a good one for selling option premium through range trading? That's what we're asking ourselves. Here's our methodology. First, we're going to observe how much a market moves from a given close. We're going to label that actual volatility. Okay, and then we're going to look at the implied volatility of the option prices. That's called implied, or what the market move is that's predicted by the option prices. That's implied. We're going to compare the two and label the bars unfavorable and favorable for selling premium through range trading. Let's just walk through this. For us to determine if a bar is good for trading butters and condors, we need to have those two types of volatility measured. Actual volatility speaks to what kind of market move was experienced from a given close moving forward. So here we are back in what, April 28th or so. We go forward 21 days, and how much did the market move? Well, it moved down, in this case, about 2.4%. And we can actually graph that with an indicator in my Metastock program. And here we need to know, to compare that, what was the implied volatility of the option prices at the time. And when we take the skew adjusted VIX, all right, the skew adjusted downside VIX was at 4.4%. That was the 21 trading bar day, or 30 calendar days, the move implied by the VIX at that time. So let me ask you, if the VIX is implying a 4.4 and yet it only actually moves 2.4, would that have been a good bar for selling option premium? Well, of course. Well, of course, you would have collected more premium than what would actually, at an implied volatility than what actually occurred in the market. So we're going to label those bars blue, where the implied volatility was higher than what actually took place. And we're going to label those bars red, where the actual move was more than what was implied. Okay, so the blue bars are ones where it would have been nice to have traded butterflies and condors. The red bars are ones where we would have wanted to avoid at the time trading butterflies and condors. So now we're going to look at what percentage of all the bars going back are favorable. This is all the methodology here. Of the bars that match our current market condition, we're going to look at what percentage of those were favorable for selling premium. And if we see there's a big difference, well, then we might have an edge, or possibly a negative edge. So here's the first statistic that's very important. If you were to go back to January of 2000 and come all the way forward to September 16th, there were over 4,200 trading bars going back that far. Of those 4,200, 64.9% were favorable for selling premium neutrally. 35.1% were unfavorable. Okay? So that's our benchmark distribution of the two types of volatility. Now we're going to look at those 35 or so instances where our market condition has occurred in the past. Of those bars that match our current market condition, what percentage of those were favorable for selling premium? And when you run the numbers, 77.1% were favorable for selling premium. Now that's a bit more than the 64.9. That's a 12.2% edge. So that means that there is a higher than usual likelihood that the market will be less volatile than what is implied by the option prices. If history plays out, we have a bit of an edge coming up with the what we experienced on Friday. Now, 35 or so isn't that much of a population to get excited about. We wish there were more, but there's not. But it's something interesting. Now, does that mean if you put on a butterfly or condor, you're going to make money? Well, of course not. You could incur, you could have 22.9% in the past turned out to have been unfavorable bars. Plus, even if it's a favorable bar, if you have a lousy way of trading butterflies and condors, well, you might lose money anyway. So what does that mean? You probably need to make sure that the approach you're using is one that's favorable for making money when you have a blue bar. So if you are using one that, if you're using an approach that really doesn't make you money, even though the market's kind of channeling, and you're maybe making too many adjustments, or just not finding good results, check us out. You may want to go to Discover Options. We have ways of trading butterflies and condors that have been time tested and proven, and we have mentors that'll really help you get up to speed in that, and help you hold your hand, get you up to a level where we have money managers coming to us. Getting help. So we have professional option traders as our mentors. We'd love to hear from you. Before we get to that market likelihood report, here's our curriculum laid out on our website. We take you from beginning, intermediate, all the way up to advanced. We have several different tracks here. You can call us. Our folks would love to speak with you and maybe formulate a curriculum that matches your needs, whether you're trading earnings, equities, futures options, or just need an option overlay to help out your long only portfolio. We would love to help you do all that. Let's look at the market likelihood report. And this answers the question, since January 2000, how often has this same condition occurred? Already answered that, around 35 or so. And what direction did the market go? So did it go up, down, stay, wobble around a little bit? And is there an edge, in either direction? So, one way to do this would be just to go to those 35 and ask yourself, well, 10 days after each close, was the market up or down, and how much? We want to get into a little bit more detail, though. We get into a bit more detail. So we want to understand from those 35, 38 or so, we want to understand the distribution of price, not just what the average price was of all those, up or down. We want to really dive in and understand the distribution. We want to understand the distribution after our condition has developed, and then we'll determine if there's a tradable edge. So here's how we do the distribution, all right? I set up standard deviation bands from the close of each bar. 5, 10, and 15-day bands. I use the 20-day statistical volatility, log normally distributed, and we measure these from the close. And so here's an example. Here's a 10-day standard deviation band set from the close. And what we're going to do is ask ourselves, for this particular close here, did the market go up and hit the upper, go down and hit the lower, or wobble around and not hit either? Okay, so let's see here. Can I just hit escape? There we go. And so what we see here is that the market did in fact go up and hit that upper band right there. Now we're sitting here. Here's the upper band, here's the lower band, and what did the market do? Let's go and take a look. Boom. It tried to hit that lower band, but failed to. Here was the band at the time, and it ended up hitting neither of the bands. See, it didn't hit the upper one either. So for that band, it hit neither of them. So what we do here is we look from every close. We record how often price struck the upper and the lower 5, 10, and 15-day bands. All right, so in a bullish market, the upper bands are going to get struck more often than the lower bands. And in a bearish market, those lower bands are going to get struck more often typically, okay? So we just want to go back, take a nice huge piece of time that encompasses both bullish and bearish markets, and determine what the distribution was in the long run. And here you go. Going back to Jan of 2000, from all the closes, when you look at 4,212 closes, the upper band got struck 29% of the time. The upper 10-day band, 23%, upper 15, about 23%. The lower bands were struck 30%, about 30%, and about 32.5% of the time. So that's the benchmark distribution of price. Okay, and these bands are one standard deviation away, of course. All right, now we have to understand the distribution after our market condition develops. So here we go, and I'm going to not only measure it from the close, but we're going to measure the distribution after price goes above Friday's high. So this is good for Monday's action. If price on Monday goes below Friday's low, we want to know what the distribution was at that point. So here we go. Okay, as of the close on Friday, with that market condition, you go back and look at the previous 36 times this occurred. The upper 5, 10, and 15-day bands were struck. Look at this, 22%, about 14%, and about 11%. These are far less than the benchmark numbers you see up here. Do you see that? So the upper bands were struck far less often. The percentage of getting struck was far less than what the benchmark was. The lower bands, look at this, were struck, all three of these were struck more often. So let me ask you, is this a picture of bullish or bearish behavior? This is clearly a picture of bearish behavior. The upper bands are getting struck less often. The lower bands are getting struck more often. This is a picture of likely bearishness. Interesting. Now, let's go look. If the price goes above the high on Friday, well, then we're seeing a little bit, pretty much the same thing. Pretty much the same thing, a little bit off, just a little bit, where if it goes above the high, well, then the upper band here, the 5-day is getting hit about the same, and the lower 15 is getting hit a little bit less often. So not quite as bearish if it goes above Friday's high. All right, now let's go to the next one. Excuse me, over here. Nope, timeout. Boom, there we go. If price goes below Friday's low, in the past that's happened 16 times. And of those, it would appear that the upper bands still get struck less often, and the lower bands get struck more often. So all in all, we're seeing a picture of bearish behavior. One thing I like to do is change up the way we draw those bands. Here we go, just a second. There we go. And we like to adjust those bands to be reflective of the VIX itself. The VIX is typically higher than the 20-day statistical. So what you have then is the VIX bands are set farther out because VIX is higher, and so the bands are farther away and get struck less often than the statistical volatility bands. Still, though, we have a bearish picture where the lower bands are getting struck more often. Generally, the upper bands are getting struck less often, as we can see here. And then we go and look at the others, and it's the same kind of picture where the lower bands are getting struck more often in most of the categories here. A picture of bearishness. So kind of strange where we have the likelihood report showing bearish behavior, yet the when we go up and take a look at the Condor Butterfly report, there's actually an edge going on right now. So, predicted. So that it's kind of counterintuitive, and because we have such few incidences, that's why I would be a little bit leery in that, ideally I like to see upwards of 100 occurrences to give it more statistical weight. So I'd be a little bit leery about going bullish or being excited about selling premium neutrally based upon this information. If you do need to be in the market selling premium, and you'd really like to right now, one strategy to consider is something that we like to take a peek at, and that is the offset broken wing butterfly. Here's how it works. We're going to take this volatility level down here, the downside VIX volatility of 17.3. We then plug it into option views number up here, the statistical volatility box. That gives us some kind of parameter, and then we basically buy an at-the-money put. This is about as close to 30 days out as we can get. Come out about as half a standard deviation, maybe a third. Sell 2. And after you do that, you go shopping for an option that's going to pretty much take up most of the credit you just brought in and leave you with a tiny little bit left over, or have it down to 0. And when you do that, you're now breaking the wing off. Instead of buying your option here, you're coming farther out and breaking the wing off, as we say. Now when you do that and analyze this, what you're going to find is that you have a real good market neutral, the flat T+0 line. If the market goes up, you're not going to lose anything, or at least in the immediate sense, you're actually going to be up 3, 4, 5% if it goes up. If the market goes down, you have a long way to go before you start getting into trouble here. So when you look at the price chart then, and look at the earnings, or the profitability, the green profitable area, it's quite wide. So that is a very common strategy here, the offset broken wing butterfly. Again, where we're trading a butterfly, but the wings are not equidistant, and you can really adjust it so that you're market neutral and your upside exposure is very, very limited, or even you can still make money all the way up there. Okay, I'm Steve Lentz with Discover Options. Thank you for joining us. We'll be back next weekend, same bad time, same bad channel. Have a great week trading. Take care. Bye-bye.